Listen, I want you to picture a kitchen table, not a metaphor, a real one, in a quiet home in Baton Rouge, Louisiana. Dorothy is 72 years old, and she's finally starting to feel like she can breathe after 40 years of working and saving. She just moved $215,000 into a high-yield savings account because the bank promised her a safe, easy 4.8% return on her life savings. That is $10,320 a year in free money, or so she thinks, while she looks at her balance on her mobile banking app. But what Dorothy doesn't know is that she has just stepped into a massive financial snare I call the 2026 interest trap. She is about to experience a negative net return, where the cost of earning that interest actually destroys her monthly purchasing power. Before I show you the math that is about to wreck her retirement, you need to smash the like button right now. The big banks and the YouTube algorithm want to suppress my finance because we expose the traps they use to generate massive fees. By liking this video, you are rebelling against a system that relies on you staying financially uneducated and quietly obedient to their rules. They want you keeping high cash balances because it fuels their lending, even if it triggers a tax catastrophe for your personal family estate. Now, let's look at the provisional income bomb that the IRS has been waiting to detonate since 1983 without any inflation adjustments. Dorothy has a modest $18,000 pension. She collects $22,800 in Social Security, and she usually makes about $2,400 in yearly dividends. Under normal circumstances, she is doing just fine, living a comfortable middle-class life in a state with a flat 3% tax rate. But that $10,320 in new bank interest isn't just a bonus. It is a catalyst that fundamentally changes her relationship with the IRS. You see, the IRS calculates your provisional income by adding your adjusted gross income, tax-exempt interest, and exactly 50% of your Social Security. For a single filer like Dorothy, the thresholds for taxing your Social Security haven't been touched by Congress in over 40 long years. If your provisional income is under $25,000, the government leaves your Social Security check alone and you pay zero taxes on those benefits. But once you cross that $25,000 line, up to 50% of your benefits become taxable, and it gets even worse once you hit $34,000. At the $34,000 threshold, the IRS can tax up to 85% of every Social Security dollar you receive at your ordinary income tax rate. Before the bank interest, Dorothy's provisional income was roughly $31,800, which meant she was already losing some money to the Internal Revenue Service. But adding that $10,320 in interest pushed her total provisional income to $42,120, blowing past that final 85% taxable threshold. This move didn't just tax her interest. It unlocked an additional $7,980 of her Social Security benefits that were previously protected from the taxman. This is the Social Security torpedo, and it means Dorothy is paying tax on money she already thought was safely in her pocket. When you calculate the federal tax on the interest, plus the new tax on her benefits, her effective marginal rate is nearly 50%. That means for every dollar the bank gave her in interest, she is handing half of it right back to the federal government. And this is before we even mention the Medicare surcharges that are triggered by this exact same spike in her annual reported income. Dorothy thinks she's getting ahead, but the system is actually clawing back her wealth through these hidden, non-indexed legislative cliffs from the 80s. The bank is thrilled to have her $215,000 to lend out to other people at much higher rates, while she takes all the risk today. Medicare Part B in 2026 is a dynamic trap. The standard premium is $290, but the government is looking for any excuse to double it. They use a mechanism called IRMA, or the Income-Related Monthly Adjustment Amount. It is a brutal wealth-stripping tool in the federal arsenal. Most people assume taxes work like a ladder, but IRMA is a cliff, and $1 can cost you thousands. If you are a single filer in 2026 and your income hits $109,001, you have crossed the line. That extra dollar triggers an $81.20 monthly surcharge. That is nearly $1,000 a year in stealth taxes just for earning $1 too much. The system is designed to punish savers. It scales up faster than you think. If you hit $137,001 in income, that surcharge balloons to $202.90 per month on top of your base. Now you're paying double the standard premium. This isn't a theory. This is the reality of the 2026 tax environment. Your financial advisor won't warn you because they profit from the accounts that push you over these cliffs. They want your assets under management. This is where the 2-year look-back rule turns into a ticking time bomb. The income you report in 2026 dictates your 2028 Medicare premiums. You might feel safe today, but the IRS and the Social Security Administration have already synchronized their databases. They are just waiting. The bill is lying in wait, and by the time it arrives in 2028, it is far too late to change your 2026 tax filing. Smash the like button right now because the banks and healthcare lobbies hate this information. They want you on the treadmill of high-interest traps. The system doesn't just want your interest. It wants to monitor every single move you make with your own physical cash. This brings us to a legal landmine buried in the federal code under 31 U.S.C. section 5324. It is a trap for the innocent. You know that banks file a currency transaction report for any cash withdrawal over $10,000. That is a routine anti-money laundering step. But many of you think you can bypass the paperwork by withdrawing $9,000 on Monday and $6,000 on Tuesday. You think you're being clever. In reality, you are committing a federal felony known as structuring. Under section 5324, the intent to avoid a report is the crime. It does not matter if the money is yours or if it's legal. The moment you structure a withdrawal, you become a federal target. In 2026, you aren't just being watched by a bank teller. You're being tracked by advanced AI pattern recognition software used by FinCEN. This software flags any structuring adjacent behavior automatically, from Baton Rouge to Seattle, without a human ever looking at your file. Imagine trying to give your daughter $15,000 for a house. If you take it out in small chunks, you've triggered a silent alert. The bank is legally forbidden from telling you that they've flagged you. You only find out when your accounts are suddenly frozen. Even in states like Louisiana with a flat 3% tax, the federal government still has its hooks in your cash flow. Stop trying to outsmart the reporting system. If you need your cash, take it all at once and let them file the paperwork. To protect yourself from the Irma cliff, move your wealth into invisible assets like municipal bonds or specific tax-deferred MyGays. These tools allow your money to grow without appearing on the income line that Medicare uses to calculate your surcharges. But as dangerous as Irma is, there's an even bigger disaster waiting for you in your traditional IRA right now. There is a Social Security torpedo hidden in the math of your RMDs that is set to detonate the moment you turn 73. Listen, Dorothy isn't a victim yet, but the IRS is already sharpening its pens for her 2026 return. You need a defensive perimeter before that 2-year Medicare look-back turns your 2028 bills into a financial house fire. The first weapon in your 2026 survival plan is the Roth conversion runway. You must move money from your traditional IRA into a Roth account in controlled strategic increments. By paying the tax now at today's rates, you're permanently killing the RMD ratchet that would otherwise explode your future income. This isn't just a tax move. It's a shield that keeps your adjusted gross income safely below the $109,001 IRA cliff. If you cross that line by even one single dollar, the government hammers you with a massive monthly surcharge on Medicare Part B. Next, look at the projected 2026 environment for multi-year guaranteed annuities, also known as MyGauze. In 2026, these are expected to offer rates between 3.5% and 4.5%, but they hold a secret the banks hate. Unlike your high-yield savings account, a MyGay allows your interest to grow under a blanket of tax deferral. There is no 1099 INT generated every year to artificially inflate your income and trigger the Social Security tax bomb. The growth stays invisible to the IRS and Medicare until the moment you decide to actually pull the trigger and spend it. For my friends in Baton Rouge or anywhere in Louisiana, you have an additional local advantage to leverage. You should be looking at state-specific municipal bonds to diversify your liquid cash holdings. These bonds are federally tax exempt, which is critical for staying under that $34,000 threshold for single filers. Remember, once your provisional income hits $34,000, the IRS can tax up to 85% of your hard-earned Social Security check. Louisiana's flat 3% tax rate and retirement exemptions are great, but they won't save you from the federal government's reach. If you are over 70 and a half, you have the ultimate legal loophole, the Qualified Charitable Distribution, or QCD. You can instruct your IRA custodian to send your required minimum distribution directly to a 501c3 charity. This money never touches your 1040 tax form, keeping your reported income lower and your Medicare premiums at the standard rate. This is the only way to mathematically guarantee that your RMD won't push you into a higher tax bracket or IRMA tier. Your bank won't tell you about QCDs or MyGAs because they want your cash sitting in their low-yield CDs. Your CPA might be too busy processing forms to sit you down and explain the negative net return phenomenon. But you worked for 40 years to build this nest egg, and I refuse to watch the system dissolve it in 40 months. Stop this video right now, open your files, and find your most recent adjusted gross income. If you are within $5,000 of the $109,000 IRMA threshold, you are standing on a live landmine. You must shift your high-interest cash into tax-deferred or tax-exempt vehicles before the December 31st deadline. The institutions are counting on you being too overwhelmed to look at the math, but the math is your only escape. Every dollar you hide legally from the 1040 is a dollar the government cannot use to punish your success. This isn't just about saving money. It's about protecting the dignity of your retirement years from a rigged system. You have the blueprints now, from Roth conversions to municipal bonds, and the power of the QCD bypass. Do not let the 2026 interest trap turn your conservative savings into a liability that drains your monthly cash flow. Take action today. Consult a fee-only fiduciary if you must, but do not leave your wealth in the bank's crosshairs. Share this video immediately with one person you know who is over 65 and still holding large cash balances. They are the primary targets for this hidden tax, and your one share could save them tens of thousands in 2028. The window is closing on the 2-year look-back period, so the choices you make this week determine your future. Stay accurate, stay angry. I'll see you in the next one.